Welcome to the very unscheduled live stream today because Congress just decided to drop the new tax bill yesterday, and I wasn't gonna go live until tomorrow. But with the new bill coming out, I didn't have a choice but to go live today and just share what I have found. And it took me probably the last 7 or 8 hours to go through 400 pages of the document. And I want to get to the point right away and some of the things that are pretty interesting. What made it, what didn't make it. No, no taxes on overtime, tips. Did not mention Social Security, but they are going a different route to reduce or potentially eliminate those taxes on Social Security, and I'm going to show you what. They also came out with the electric vehicles, clean energy breaks, some of the ways for them to increase taxes, and here are some ways they're going to do it, like the carry interest loophole in the sports teams, executive pay, and as well as the international transactions. That's going to be taxed now too if you send money from the U.S. to a foreign country. Universities and foundations. In some universities, and I'm sure you're following what's going on between Harvard and the Trump administration. There's a lot going on, but they want the universities to pay an annual tax up to 21% on their annual net investment income, which is up from 1.4% today, which is very, very significant. I already mentioned the no taxes on tips and overtime, and they're going to come out with a new savings account. So the universal savings account did not make it, but they have a savings account called MAGA, like literally Make America Great Again, MAGA account, which I'll get into that. Car loan interest that did make it, and the senior deduction, as well as some other SALT deduction I'm going to go over. There's a lot of stuff going on. 2025 has been wild, and I appreciate every one of you guys tuning in. And I'm going to get into it right away. I wanted to wait just a little bit because I understand that YouTube ads do run at the beginning, unless you're on YouTube Premium. So I wanted to just give it a minute until people could kind of tune in now and 30 seconds or about a minute in so that we can go in. But just real quick, if you're wondering where to find the bill, and this is probably the most common question that I get, is by going to the Ways and Means Committee. And probably about 20-30% of Americans know what the Ways and Means Committee is, but they basically do everything about taxes, tariffs, and everything. They're the biggest committee, probably the most important House committee out there. But go to the Ways and Means Committee and then go to markups and make sure you click on May 13th, which is today. And they are scheduled to go live at 2:30 p.m. Eastern Standard Time or 11:30 a.m. Pacific Standard Time. And I am not going to be live for that one, but I am going to post a link right here. And there we go. Should have posted just now, and it's going to be in the live chat. And you can watch that live. They're going to argue back and forth about the bill, and they haven't dropped the amendments to the bill just yet. So I want you to keep this in mind, is that this is all proposals. Proposal means nothing is final yet. Right now, the Republicans are still having disagreements over a few amendments, a few sections in the bill, and they're going to argue over that too. And there are some Republicans came out saying on X that they are not going to vote on the bill. And Mike Johnson, the House Speaker, he needs every Republican bill pretty much because they have a very narrow vote between the Republicans and the Democrats. So they need to go in there and get those votes. And that kind of led to the SALT deduction making it to the final bill because they needed those California and New York House Republican votes. But anyway, you can click on that. Once you click on that link, and then that's where that committee markup is going to be. They're going to have that meeting. Again, that's going to be 11:30 a.m. Pacific Standard Time and 2:30 p.m. Eastern Standard Time. Unfortunately, I am not going to be live for that one. I have a bunch of client meeting today, and you can sign up for a 60 minutes consultation with me as well at firesightshare.com/consultation. And I apologize in advance. And I know people reached out and said, I can't find a date and time that works for me. I am literally swamped with about 3 to 4 weeks out So if you do sign up and you can't, or, you go to the website, you can't find it, just email me, email the team at hello@firesidechat.com. But anyway, right now, you can go on that website and find the bill in there. And let me make sure that I can switch share to this tab instead. Okay, there we go. And that once you click on that, this is what you're gonna get. Okay, and this is today's date. You click on it, it's on YouTube, so you can't miss it. It's all free. But anyway, all right. With that said, I'm gonna get into the bill now. I don't want to waste anybody's time, and I don't like to waste my own time. So let me go ahead and pull up the bill here, and we can go over that together. And I did take notes so that I can give you guys more of the summary of what it says. So this is the one big beautiful bill is what they call it. Just the messenger. Please don't shoot the messenger, okay? And I'm just gonna deliver all this content unbiased, and so you can make your own judgments in the live chat or in the comment section, whatever you want to do. You want to argue amongst yourselves, go for it. All right. Anyway, all right. So the first one is pretty much carrying over all the tax brackets from the previous year. There's a separate PDF for that. That's more in detail, but what that says is pretty much striking 2017 to basically there's no end date, so they're going to make all the tax brackets permanent. Again, it's a proposal, right? So just keep up with what's going on. And the first one, as I said, that was the permanent tax breaks. And before January 1st, 2026, I'm not going to get too much into it, but pretty much all the tax brackets are remaining the same. The second section was extension of increased standard deduction and temporary enhancement. So right now, this year, we're going to get the standard deduction for $15,000 for single individuals and $30,000 for married filing jointly, and the head of household is $22,500. So the most interesting part was between 2025 and 2028. So January 1st, 2025 until December 31st, 2028, they're looking to increase that standard deduction for married filing jointly by an additional $1,500, and that does not include the COLA. So that would be the cost of living adjustment or inflation increase, right? So standard deduction does increase by inflation every year based on the CPI, right? And the head of household is also going to increase that by $1,000. So for the next year, this is all going to take effect. So I thought that was interesting that they added an additional standard deduction. And if you don't know what standard deduction means, the $15,000 is the first $15,000 that you earn is tax free. So if you earn $100,000 gross earnings from your W-2 job, the first $15,000 is going to be tax free. And the remaining $85,000 is going to follow that tax brackets from 10%, 12%, and 22%, 24, 32, 35, 37%. Okay, that makes sense? Now, moving on to this one here. The effective date, already talked about that, and applying to the tax year beginning after December 31st, 2024. So that's going to be the majority of the bill, but some of them do say after 2026. So I will point that out. This is going to be the elimination of personal exemptions. We haven't had personal exemptions since this not Secure Act 2.0, but the TCJA was passed in 2017. So there's just no more personal exemptions, and that's just going to be the permanent. It's going to be permanent in the bill. And the next one is extension of increased child tax credit and temporary enhancement. So right now, what this means is that for tax years starting after December 31st, 2024, and before December 31st, 2028, I wrote that down, the amount used in calculations will be changed from $1,000 to $2,500. And then for any tax year after 2028, the amount will be changed from $1,000 to $2,000. So essentially, it's going down from $2,500 to $2,000. Okay, and that's what it says. That's what the bill says. And right here, this is going to show up in almost every section. Social Security number is required. So this is something that Trump and the House Republicans were pushing. is that every tax credit or deduction is only going to be for people with social security numbers. And they were talking a lot about the illegal immigrants in the country and how they were getting the credits or whatnot. That's what they were saying, right? And I don't know that for sure. I don't, I'm not in that. I'm not in the government sector. So, but that's what they were advocating for. And so, social security number is going to be in pretty much every section of the bill. Now, scrolling down here, so starting with tax years after 2024, the $1,400 refundable portion of the child tax credit from Section 24H5 will be increased for inflation each year. So it's going to be rounded to the $50. So if the child tax credit is, let's say, $2,000 one year, $2,500 another year. Well, I'm sorry. Let's say go from $2,000, then and then inflation adjusted by let's say 2%. Then the most it's going to go up is $2,050. They're just going to round that up, right? And let's say inflation goes to like 10% one year, which is insane. Then they're going to adjust by inflation, but they're going to round it to the $50, if that makes sense. Okay. Going into, and let me see. No. Somebody was saying that a summary of these highlights on a link or one or two slides. You can go to firesightshare.com/community and join the private group. And I'm going to have a summary for those. And this is just kind of going over on the live stream. Talked about the inflation adjustments here. All right. So the increase is based on cost of living adjustment. So again, this is as a reference for 2016. And beginning with tax years of after 2028, the $2,000 total child tax credit will also be adjusted annually for inflation using a similar COLA formula. So yeah, pretty much the same thing from before, and now it's just going to be on a permanent basis. Okay, COLA for this one is actually $100. All right, let me go ahead and scroll down just a little bit more. Extension of deduction for qualified business income. And all right, so this is the if you're a business owner, this affects me because I'm a business owner. And so if you are not familiar with Section 199A, don't worry about it. But basically the business deduction, right? It's going to be increased from 20% to 23%. So if you don't own a business, don't worry about it, but it's in there. But if you are a business owner, just go to Section 110005 under extension of deduction for qualified business income and permanent enhancement. Okay. And let me go ahead and scroll down just a little bit more here. A lot of it is just the legal jargon that you can kind of go through. Deduction for qualified business income to apply for certain interest dividends of qualified business development companies. All right. And that includes REITs as well. And let me see. I doubt that anybody is really issuing REITs as a business, unless you're a real estate broker or owner. All right, so down here, this is the estate tax, also known as the death tax. So they're striking $5 million, which was what was written in the original bill, or in the tax subparagraph A, and now it's going to be $15 million. So they were talking about eliminating this whole estate tax altogether, but right now they're still limiting that to $15 million. And I'm guessing that they had some Republicans opposing this. So as of right now, it is still left on there. And then for extension of increased AMT, so this is permanent AMT exemption. The brackets are on the IRS website if you do have to file AMT every year, which is on there. But this is going to be staying there on a permanent basis. Let's see. All right. So mortgage interest deduction, that was one of the items they were looking to eliminate. But right now they did leave it in the bill. And this is something that they're going to argue in the during the committee meeting. So right now, the permanent mortgage interest deduction is going to be holding at $750,000 in mortgage debt for primary home as of right now. That's what they have. And the next one is the extension of limitation on casualty loss deduction. So this is pretty much for all the personal casualty losses. Pretty common for people in California who had to go through wildfire in LA or in Northern California. and as well as hurricanes, tornadoes, and all that stuff. And it's just FEMA declared disaster area. So all those losses become deductible only if the loss occurred in a federally declared disaster area. So it was set to expire at the end of 2025, but now this is going to be a permanent thing. And no, don't need to go over that. Okay, so termination of miscellaneous itemized deductions. So that we haven't had those in like the last 8 years anyway, but there were the unreimbursed employee expenses, tax prep fees, investment expenses, and hobby-related deductions. So they're going to strike those permanently after 2025. Limitation on tax benefit of itemized deductions. So this one is the lesser of the amount by which your taxable income exceeds the threshold where the 37% tax bracket. So if you don't know what this is, they have this formula. It's called 237 formula. So if you have taxable income, let's say, this is for high income individuals, right? So if you make like $600,000 a year and your deductions are $50,000, then they're going to reduce the deductions using the 237 formula. So they do $50,000. If you look at it down here, I'm going to circle this. You see $50,000, right? So they multiply that by 2 and then divide it by 37. Then it's $2,700. Which is the reduced deduction using the 237 formula. That's what this is. And this is going to be placed on a permanent basis as well. That's more for the people in the 37% tax bracket. And the next one is the termination of qualified bicycle commuting reimbursement exclusion. Again, we haven't had that in a while, but this is going to be more on a permanent basis. And the prior law allow people to deduct up to $20 a month in employer reimbursements for bicycle commuting expenses from taxable income. That probably apply more to the cities like New York City, DC, and other cities that use more bicycles as commuting method. Anyway, all right. So in the next one, deduction for moving expenses are also removed permanently. They're just going to strike January 1st, 2026, and it's going to be made on a permanent basis. All right. Now, going forward, extension of limitation on wagering losses. Yes, they did talk about the SALT deduction. I'll get to that in a second. You can still deduct gambling losses. So this is more on also added section 165D. So if you like to play, I'm in Vegas, but I never really gamble. I know how to play them, but I never really gamble. One night, the most I've ever won was like $7,000 from the craps table, winning all the hard ways. But if you lose, like, let's say $4,000, and then you can deduct that from the total winnings, and just, this is becoming more on a permanent basis. So that's what that is. And the next one is extension of increased limitation on contributions to ABLE accounts. So ABLE stands for Achieving a Better Life Experience. So if you know anyone who is disabled or just individuals with disabilities, they can contribute more than the annual gift tax limit to their ABLE account. They're just making this more on a permanent basis. And they're going to strike 1996 and 1997, and they're going to add that clause by striking before January 1st, 2026 on there. So if you know someone who is, with disability, this is a pretty good information to share. The next one in section 110016, that is extension of savers credit allowed for ABLE contributions. Again, this is about for individuals with disabilities, but this is more talking about the section 529A. So section 529A will be the college savings plan. So we're going to talk more about the 529 as well. There's some huge changes to the 529s that I'm going to go over. So individuals with a disability qualify for the savers credit, and the savers credit can be worth up to $1,000 a year or $2,000 a year if married, filing jointly, depending on your income and contribution amount. And there is a phase out range, but you can look at it on the website, on the IRS website. Okay. Going down the line here, there's just talking about the coordination with Secure Act 2.0. Okay, so this is the rollover funds from a 529 college savings plan to an ABLE account. And this is also going to be made on a permanent basis. extensions of treatment of certain individuals performing services in the Sinai Peninsula. So this is more for veterans or active duty military. So they're making Kenya, Mali, Burkina Faso, and Chad are going to be included in the hazardous duty areas, and they're going to be paid. So armed forces active duty members will receive hazardous duty pay or hardship duty pay for being deployed to those areas. So if you're not a veteran, you will know what this is for, and it will be irrelevant to you. But if you are an active duty member, when I was deployed to Iraq and Afghanistan back in 2006, 2008, I received hardship duty pay because I was in the hostile fire or imminent danger zone is what they called it. And it was a tax-free payment from them saying that, hey, here's extra, I don't remember, it was like $150 a month, which was a lot to me back then, right? Pretty much kind of saying, hey, here's extra money for deploying to these hazardous areas. So yeah, these are the countries that got added to the hardship duty pay. Going down the line, 110019. So this is the student loan discharges due to permanent disability or death are excluded from taxable income. This may not apply to many of you, but you may know someone who has student loans. So when your student loan is forgiven, depending on what type of forgiveness you get, it is considered a taxable income. So if you make $75,000 a year and your $70,000 in student loan was forgiven for whatever reason, and they're going to issue you a 1099 saying that you got this as a taxable income. So now your taxable income total is going to be up to like $150,000 if you combine your W-2 and the student loan forgiveness, and you have to pay taxes on it. This exclusion just means that if you become permanently disabled or you die, then you don't pay. The student loan discharges will no longer be taxable income. And but that's what that is. And if you know someone with a student loan, just make sure you let them know. Couple other things. Let me double check here. Yeah, again, you're gonna see quite a few things. Social Security number. That's the House Republicans wanted to make sure that Social Security number requirement is in almost every section of the bill, and I wouldn't be surprised if that makes it to the final bill to pass what they call it, the big beautiful bill. Anyway, all right, moving on. Additional tax relief for American families and workers. So this is what people wanted to know. No taxes on tips, right? But what's interesting about this is that they talked about the qualified tips, but if you read through this, and I want you to read through this on your own too, because I don't want to stay here and live stream for the next 3 hours. It's cash only tips. Let me think about this for a second. Okay. So, I know you're supposed to report your tips, your cash tips on your W-2. I don't think most people do, right? And correct me if I'm wrong, but for this verbiage, it just says that just cash only tips will be considered qualified tips. This is just the proposal. It doesn't mention anything about the credit card tips. You know how you swipe, right? And you add tips to it at a restaurant or wherever. It doesn't mention anything about those tips being tax-free at all. So maybe they're going to make a revision on it. Who knows? That's something that would worth keeping an eye on. Certain sectors, like certain sectors that require their employer to distribute tips, kind of like going to the hair salon. Yeah, you have workers there, and they do all the work, and at the end of the day, the employer just distributes all those tips. Those are on there. So the tips on those distributed by the employer are not going to be taxable. But from this verbiage in the bill, it just says that any cash tips reported on the W-2 income is not going to be considered taxable. Okay. So interesting on that. And the next one I wanted to go over. Oh, and this is what I was just talking about, all the specific services, barbershop, hair care, nail care, aesthetics, body and spa treatments, those kind of stuff. And that's going to be on there. And it does say that the Department of Treasury is going to give a list of all the industry and occupations that's going to qualify for tax-free tips. So I would stay tuned on that. And knowing how the government works, just remember they are slow. I'm a 20-year Air Force vet, and I know how slow the government is. Okay, so just keep an eye on it, and I wouldn't be surprised if they had to push this back by another year because they couldn't get all the paperwork in, whatever that is. But just keep an eye on that if that does matter to you. Now, the next one, I'm going to scroll down here. That's all the bunch of tip stuff that you can read through. Oh, yep, already talked about that. So they're going to list all the occupations. Okay, all right. So no taxes on overtime. That made it on there. So this is different. I thought whatever hours that you work, let's say you make $20 an hour, or let's say $30 an hour, and you work overtime and they pay you $45 an hour. And I thought they were just going to go tax free on the whole $45 an hour. No, just no taxes on the differences between the regular pay and the overtime pay. So if you make $30 an hour on a regular basis and you work 40 hours a week, you still have to pay taxes on it. But let's say you work 48 hours in 1 week, you got 8 hours of overtime, and you made $45 an hour. You still have to pay $30 an hour on taxes, but you do not get taxed on the $15 an hour. That makes sense? That's what it says on the bill. Feel free to take a look, but I was kind of caught off guard on that. I thought they were just going to go tax-free on the entire hourly wage, but that is not the case at all. Anyway, yeah, but that is section 110102. No tax on overtime, and then qualified overtime compensation, that is going to be on there as well, and you can read through those. And let me go ahead and yep. So right here under line 2, it says earn income in excess of the dollar amount in effect under section 414, what we talked about. And again, Social Security number required. Okay, let me go ahead and scroll down just a little bit here. And there's no income limits on this, is what I didn't find any income phase out range for the overtime. Let's see. Okay. Okay. All right. No, they didn't mention anything about cutting taxes on Social Security. However, in order for them to go tax-free on Social Security, they just added the standard deduction for people over the age of 65, an additional $4,000. Okay, so let me demonstrate what this means. So let's say you and your spouse make I don't know, let's say what's the combined, let's say $70K a year on Social Security. Okay, and that is going to be, well, that's a little too high. Let me do this. Let me do 4,000, 3,000. Let's do $2,000 a month. So that would be 24K per year. All right, so let's do 24K a year on Social Security. And let me go and move this over here. Okay, so you get if you're single, you get 15K in standard deduction, right? So you don't get taxed on the first $15,000. And if you're over the age of 65, you're going to get an additional 4K standard deduction. Okay, so if you collect $2,000 a month, you're going to get an additional 4K a year in additional standard deduction, but you would still owe taxes on the taxable income on $5,000, and that becomes taxable income from the Social Security. So you're not entirely tax free. Could your CPA find something to deduct your taxes? Possibly, right? This is where CPAs will come in and say, yeah, you could probably deduct more by doing this and that, but 5K will be 10% of the $5,000, so which would be $500 that you will owe taxes on, and that's what it's going to come down to. So from what I read from the Republicans is that they could not eliminate all Social Security taxes without adding any more deficit to it. So they want to do this gradually by adding the standard deduction for people over the age of 65. So this year, right now, they get the 1,550. And starting in 2025, if you're over the age of 65, then you get $4,000. $4,000 a year, depending on what your Social Security income is going to be. If you're in the lower end, it might be a big deal. If you make $48,000 a year because you're collecting it at the age of 70, it might just be a little bit of change, right? And it really depends on your financial situation. Like, I could easily say this is $48,000. Let's say a couple retires on, I'm going to make it simple. Let's say $50,000 a year. A husband and a wife retire together, right? And their standard deduction is now up to $30,000. And then they add, if they're both 65 and over, now that's going to be going up to $8,000 total. So, but you're still going to be owing the $12,000, but not $12,000, but $12,000 becomes a taxable income, and you will be taxed at 10 and then 12%, right? You're still not reaching that 22% marginal tax rate, but you will be at that 10 and 12%. 12% would be your marginal tax rate. So depending on that situation, it's not a complete tax-free situation, is all I'm saying. So I know they said they wanted to do no taxes on Social Security, but this bill does not say that you're going to get tax-free as of right now. Anyway, and as far as income phase-out range, yep, it does say starting at $4,000 by 4%. So that would be 4% of so much of the taxpayer's modified adjusted gross income as exceeds $75,000 or $150,000 for a couple filing their taxes jointly. So keep that in mind. And if you don't know what your MAGI is, modified adjusted gross income, just take a look at your previous year's not W2, your 1040 tax return from 2024, and you can find that section there. But yeah, anyway, just let's see. That's all Social Security here. All right, so the next one is going to be the no tax on car loan interest. And what I did not find is if this is going to be the above the line interest, kind of like the like the mortgage interest is not above the line. So if you itemize your deductions, then you can if your mortgage interest, let's say, exceeds $15,000 a year and the standard deduction is $15,000, then you can itemize your deductions, right? And you get more tax breaks from there. But this one, no taxes on car loan interest. So this one says beginning on January 1st, 2025, and it's temporary, it's not permanent. And because it does expire on December 31st, 2028, and this is 2020, so 2024 through 2028, for special interest, for personal interest. Okay. So you have to have the qualified passenger vehicle loan interest. And this is how they define it. You have to have a qualified passenger vehicle loan interest, meaning any interest which is paid for or accrued during the taxable year on indebtedness incurred by the taxpayer after December 31st, 2024. So for the purchase of, and that is secured by a first lien on an applicable passenger vehicle for personal use. Exceptions: such terms shall not include any amount paid or incurred on any of the following. So a loan to finance fleet sales, a personal cash loan secured by a vehicle previously purchased by the taxpayer, a loan incurred for the purchase of a commercial vehicle. So basically, it needs to be your personal vehicle. That's what it is. Okay. The dollar limit for this is that the amount of interest per year needs to be cannot exceed $10,000. Limitation based on modified adjusted gross income, and there is an income phase out range as well. So they do reduce that $10,000 for each. So they're going to reduce it by $200 for each $1,000 that you exceed that modified adjusted gross income. And if you're a single individual, that will be $100,000. And then if you're married filing taxes jointly, that would be $200,000. So if you have a car loan right now, maybe take a look at your latest statement and see how much you paid in interest every single month, and total that up by every month. And obviously the interest does go down as you pay your car off along the way. But see what the estimated amount is going to be and see if that's going to let you qualify. So remember the differences between tax deduction and credits. Tax deduction means that if you get, like, let's say $10,000 in tax deduction, look at your marginal tax rate. So if your marginal tax rate, let's say it's 24%, 24% of the $10,000, that would be $2,400, right? So that $2,400 can come back into your pocket. But if you are, let's say, getting a tax credit for $2,000, that is $2,000 straight into your pocket. That's just a credit, not a deduction. So make sure to understand the differences as you're going through the bill. So I don't want you to have like any confusion on, oh, am I getting all this $10,000 back? No, it's $10,000 multiplied by your marginal tax rate. So you got to know what your marginal tax rate is between federal and state. But in this case, it's just federal, not state. Okay. Let's see. All right. So applicable passenger vehicle. And I'm sure people are going to ask, what type of vehicle am I going to qualify for? So the type of vehicle you're going to qualify for, it needs to have two wheels. All right. So a car, minivan, van, sport utility vehicle, pickup truck, or motorcycle. I know some of you guys love motorcycle on my channel, and I have no idea why, because I use some of the B-rolls with motorcycles. And I don't know, people just went crazy with it in the comment section. But anyway, all-terrain vehicle designed for use on land, or any trailer, camper, or vehicle designed for use on land, which is designed to provide temporary living quarters for recreational camping or seasonal use, and is a motor vehicle or is designed to be towed by or affixed to a motor vehicle. Now, there is a caveat to it. So what happens if you refinance, right? There is a clause for that too. So refinance amount cannot exceed the original loan balance being refinanced to. So let's say you have a $20,000 vehicle, and then you decide to refinance it for, let's say $20,000, refinance it to $22,000. Then that interest that accrues from that extra $2,000 is not going to be writable on your against your tax deduction. That makes sense, right? So $20,000 is the original loan amount from the first time you bought that car. And then if you refinance it for a higher amount and that $22,000, and let's say a difference of $2,000, again, the interest that accrues from that $2,000 is not going to be deductible against your taxes. I hope that makes sense. Okay. All right. The next one is, that's just more about the passenger vehicles. Let's see. Oh yeah, here's a good example. I did write this down. So if you have a $30,000 car loan and 7% APR, which is pretty the average car loan that you get nowadays, and let's say you finance it for 60 months, and that's about a $600 car payment, and per year it's about $1,100 a year on interest. So if you're single, you make less than $100,000 a year, and married, filing jointly, less than $200,000 a year, then $200 deducted for every $1,000 above the income limit. So if you go $110,000, then it's $200 deducted from the total interest that you can write off, which is $10,000. Okay, I hope that makes sense. Cool. The next one is enhancement. Oh yeah. So this is more for employers. So enhancement of employer provided childcare credit. So if you if you ever go to like a huge company and they have their own childcare services, so basically they can they get some of the credit under subsection A, and then you can read through that. I'm not going to read through all of that. But if you do care about the employer provided childcare credit, if that applies to you, make sure you go to section 110105 on page 47. Okay. And the next one is going to be, what is this? Oh, okay. Yeah. So this is an extension and enhancement of paid family and medical leave credit. So PFML, so this is just basically keeping the medical credits in place, and looks like this is more on a permanent basis going forward. If this applies to you, this is also in section 110106. All right, so let me go down to more of the common ones real quick here. And cool. If you're watching this and you really like this type of content, let me know in the live chat. I really appreciate it. And I spent a lot of hours just going through this, and I wanted to point out the ones that you most of you care about. So I really enjoy. I don't know why I enjoy reading this. Most people don't. I shouldn't, but I'm also a nerd. So anyway, all right. Enhancement of adoption credit. That's also going to be permanent for $5,000 shall be treated as a credit. So this is a tax credit. Okay. So that was a good one. And I'm going to go through the 529 real quick. Oh, and one more thing that was added was the inflation adjustment for the child tax, not child tax credit, the adoption credit from $5,000. So the inflation adjustment is going to be increased to the nearest multiple of $10. So that's something that was added there. If you are looking to adopt kids, that applies to you. Okay, next one. Okay, so this is more for the tribal government adoption credit. Oh, and the HSA, I'm going to go over that too. There are a lot of changes for the HSA, so I'm going to get through this as quickly as I can. This is more for the tribal government. They're just adding that to for the child. What is it? The section 110108, recognizing Indian tribal governments for purposes of determining whether a child has special needs for purposes of the adoption credit. So this came from another HR House resolution. They just added this to the section 23D D3. So that's good stuff. All right. So next one. This is a big one. So tax credit for contributions of individuals to scholarship granting organizations. So tax credit. So we're going to go through the tax credit limit here. So in general, let's say you are someone who wants to donate your money to a charitable donation, right? So if you decide to donate to a qualified scholarship organization, you could donate up to $5,000 or 10% of your AGI per year. You get that tax credit. Okay. So you got to find, if you're already doing this, you know who the eligible SGOs are. SGO, that's scholarship granting organizations. Again, right here, it says 10% of the adjusted gross income. And then the $5,000 is the maximum limit. Okay. Eventually, I would like to donate to scholarships too. That's something that I do believe in, because that's, the kids are our future, and, what they do for our future is going to matter a lot. So that's something that I do believe in. I'm going to go down. This is all scholarships here. I'm going to go down to, sorry, there are a lot of pages here. There are 389 pages on this one. This is all just kind of talking about the states that qualify for it, and what happens if, the failure, what happens if the organization fail, and all that. That's something that you can read through on your own. I believe it's on page 73 real quick. There we go. All right, page 71. This is a big one. This is about the 529. So if you got kids, and it doesn't even have to be kids, you can fund your own 529. That's also the common misconception, is that, oh, I got to have a kid to have a 529. You can actually fund your sister. You can fund your parents. You can fund anyone in your family tree with a 529. That's been the law for a while. Okay. But the biggest thing about this 529 section here is that it allows you to contribute and use the 529 for homeschooling. So that was added. So there, a lot of people kind of switch over to homeschooling since COVID happened, right? And so there's still tuition costs, and you hire tutors for your kids who are homeschooling. That's all going to be a part of the qualified education expenses on the 529 account. So officially, it is called Section 529C7. So treatment of elementary and secondary tuition. That's all on there. So tuition, curriculum, any public, private, or religious school. Historically speaking, 529 has always been like a higher education for like colleges, right? But since Secure Act 2.0, 529 allow people to use, it was the first Secure Act. They allow people to use the 529 to fund their kids' private tuition. So private college, private high school, private K to 12, and they can use that 529 to pay for the tuition expenses and books and stuff like that. And this is expanding over to educational classes outside of the home. So this is huge. Like, I have a 12-year-old daughter, and I would love to get her a tutor for to either learn another language or work on a subject that she she needs to work more on. And the 529, which I've had it open since the day she was born. I could use that to pay for her qualifying education expenses, right? So this is pretty big on that. You can take a look. The amendment, this is going to be effective date is going to be upon enactment of this act. So if you see any bill that says effective, let's say January 1st, 2026, that means that's the date that it's going to start. But if it says upon enactment of this act, it means that as soon as President Trump signs the bill, then this is going to become become a law right away. So anyway, that's something that you want to know. Just to answer your question real quick in the live chat. So they are the Republicans are looking to pass this by the end of this month. That's the House Republicans, and then it's going to go to the Senate, and the Senate is going to vote on this, and they're hoping to have, according to the news, they're hoping to have President Trump sign this bill by the 4th of July. So if you're worried about the federal employee pension plan, I know that was the last live stream I did, when that was going to go into effect, that would be the date that you, maybe in June around there you want to pay attention to. A lot of this stuff was upon enactment of the act. So high five salary and all that stuff that might happen as soon as he signs the bill. So that's something that I would keep an eye on. And I posted a link, if you scroll up in the live chat, on where to go in the Ways and Means Committee. So scroll all the way up, and I put the link in there. You don't need me to go through this, and you can read this on your own, but you're listening to this for a reason. So I just want to make sure that you guys are aware. Okay, so anyway, 529. Additionally, it'll pay for fees for testing, continuing education, which is also huge. Okay. State lien prepare under Section 122, Workforce Innovation and Opportunity Act. The other thing that I found was the VA. I'm a veteran, so it's a big deal to me. The WEAMS public directory, any programs listed on that is also qualified qualified educational expenses. And the other thing was the COOLS program on the active duty side. So if you're getting secondary education while you're serving in the armed forces, they're gonna recognize those as the educational expenses too. So again, you can open a 529, which is managed by the state, and you can list yourself as the beneficiary. So if you're single, you got no kids, but you're looking to do some education in the future, why not start investing into your own 529? And then when you're done with it, you can actually transfer your beneficiary to someone in your family tree. If you're the type of person who says, I never want to have kids, but let's say your sister's kids or your brother's kids have, they want to go to college or something, you can transfer that beneficiary over to them while you're still the custodian. So, that's something that you can do for your family tree. So yeah, I talked about the COOL directory here for the armed services guys, military guys. And a lot of apprenticeship. So if you're looking to become looking to go to trade school, that's all going to be qualified educational expenses. That's all on there. This is charitable contribution. So they're going to increase that from $300 to $600. Most people don't really. Well, this is relevant anyway. If you like to donate clothes and toys or whatever to Goodwill or whatnot, just striking 300 to 600. It is not going to be adjusted by inflation, so that's just the way it's going to be. Let me go ahead and scroll down just a little bit more here. So student loans, we talked about that already. So employer tuition assistance. So right now, the maximum employer tuition assistance. When I was in the private sector job before this, my employer was reimbursing me up to $5,250 a year on my college tuition, right? So it was pretty sweet. Now they added the inflation adjustment, so they can increase it from $5,250 to $5,300, $5,450, stuff like that. So this is going to take effect after December 31st, 2025. So this is not going to take effect until 2026. All right. Next, it is going to be the extension of rules. Let me see. Disaster-related personal casualty losses. I already talked about that. All right. So the next one is going to be interesting. It's called a mega accounts. So this is a Make America Great Again savings account. So it's kind of like a Roth account that they created. This is not a universal savings account. That did not make it to the bill. But this one called a mega account. If you're wondering why they named it that, I'm not going to answer that. But anyway, so in section 511, they're going to add this to the savings account. So who this belongs, who's going to qualify for this? So this is going to start before January 1st, 2026. So it's going to be during this year as soon as they sign it into law. So it's going to be the account beneficiary who is not yet 18 years of age. And no distribution has, okay, so wait, hold on. So 18, and you have to be before 18, and you have to not be 8. So your kid has to be 7 or under to create this account. So this is effective 2026, and it cannot be in cash, and you have to be under 8 in 2026 to open this account. So if you have younger kids, this might be beneficial to them. Then you would still, this is a custodial account. So you as the parent or grandparent would be in charge of this. And let's see, going down here. So index of, so you have to invest in US stocks or US or something equivalent diversified portfolio. You cannot leverage this portfolio and minimize its fees and whatnot. And contribution limit per year is going to be $5,000. So it does grow tax-free under this account. So this is a way for the government to encourage kids, parents to start contributing money to their kids. And this, I guess, this is one way to do it, even though there are other accounts that's already available. But I guess this is something they wanted to add. And they do have qualified rollover contribution. It does not state if they're able to roll that over to a Roth IRA, but we'll see what happens with that. But and this just by inflation by $100, so a multiple of $100. So if inflation goes up, and it could go from $5,000 to $5,100. And for qualified distributions, so it has to be for a house. So if your kid buys a house, or it says for retirement, but it doesn't say if you can roll that over to a Roth IRA, because this is a after-tax contribution. But it does not say, if you can roll that over to a Roth IRA, but it does say you can roll that over to, you can buy a house with it, and you can pay for college with it as well. So it does have limitation on what you can use it for. So if you look down here, it'll be qualified expenses, higher education expenses, post-secondary credential expenses. And the second one of this is that you actually get a stimulus check for the kids. So if you were born, let me scroll down here, and if you were termination, hold on. There's a stimulus of $1,000. So the federal government is going to pay $1,000 to the MAGA account if you were born between 2025 and 2029. Let me find a section that said it on there. There's so much stuff on there. One second. Okay, there we go. All right. So it's under section 110116. So this is a pilot program. I'm not sure if this is actually going to pass, but they really want it to happen. But the federal government is going to give a one-time credit of $1,000 with respect to each such eligible individual who is a qualifying child of such taxpayer, which shall be payable by the secretary only to the MAGA account with respect to which such eligible individual is the account beneficiary. So in order to qualify for that, you have to be born, where's the date? There we go. You have to be born after December 31st, 2025. So you have to be born on January 1st, 2025, and before January 1st, 2029, which means December 31st, 2028. So it's just during those years that you're going to be qualified for that $1,000 in stimulus into your baby's account. So you know. But yeah, okay. So I'm gonna move on here. That's just talking about how you need to provide Social Security. All right, this is the start of the HSA. You ready for this? Okay, so this is just about the HRA upgrade, the health reimbursement arrangements. I'm not going to go too much into this, but if you go to section 110201, it's about the HRA. But let me go to page 113 here, and we're going to start talking about the HSA here. All right, so individual entitled to Medicare. So this is a huge one. So for the longest time, HSA was born in 2004 under President Bush when they signed the HSA Act of 2004. And the original law says that if you are enrolled in Medicare, you are not eligible to contribute to the HSA, right? You can still take money out of the HSA and whatnot, but now if you're over the age of 65 and you're enrolled in Medicare Part A, you can continue to contribute to your HSA. So this is huge, right? Part B is insurance, Part C is Medicare Advantage plans, and Part D is drugs. And you can still pay for those out of your HSA. So HSA is great, right? So if you don't have an HSA, I encourage you to take a look at it, but just make sure that you are not incurring a lot of medical expenses. If you have like an ongoing health issues, then that could cost you more and become counterproductive if you have to use the HSA money, because it is a high deductible health plan. But this is going to cover not just your insurance, Medicare Advantage plans, and drugs, but you as a retiree can continue to contribute into the HSA as an individual or on a family plan. So this is really big. If you are 65 or you're coming up in your 60s, this is something that you do want to know, and let your parents and grandparents know if they are looking to continue to contribute to the HSA. Let me go ahead and scroll down here. And just real quick, I know I made a video about 2 weeks ago saying that HSA was on the strike list. It was. And it was on the strike list, but it looks like they're going to make it even better with more benefits. So I'm going to go through that real quick. So this is going to take effect in 2026. So if you're going to be 65 in 2025, you still have to wait until 2026 to start contributing to your HSA. All right. Treatment of direct primary care service arrangements. Okay, so that I'm not going to go through that. You can read that on your own. Let me go down here. Okay, this is big, and this is from the HR 5687. So allowance of bronze and catastrophic plans in connection with health savings accounts. So now this is bronze and catastrophic plans will be treated as HDHP. So therefore, you can start contributing to your HSA under this plan. This is something that I did write to my congressman about to make sure to add this to the bill. So I don't know if they read my email or my letter. Hey, I'm really happy to see that to be included. All right. And this is going to take effect also in 2026. And on-site employee clinics, that's something that I mentioned earlier. You can also take a look and read about it. It's just kind of the expanding the qualified medical expenses with the HSA. You can read that on your own. And let me go ahead and scroll down here. Okay. There are certain amounts paid for physical activity, fitness, and exercise treated as amounts paid for medical care. That's going to be added to the HSA as a qualified medical expense. Again, this is a proposal, so I don't want you to take it like, woohoo, this is going to happen. This is not signed yet, and nothing is final until this gets signed. All right. So qualified sports and fitness expenses. So if you go to the gym and you pay, you have like a membership fee at the gym. This is now considered a qualified medical expense, which is really huge, right? But it cannot exceed $500 or $1,000 a year as a if you're married, filing taxes jointly, or a head of household. There is a monthly limit on there, and it does state on what the amount is going to be. Fitness facility. So if you go to like any, I don't know, like a 24-hour fitness or something like that, and you pay for a membership fee, you could reimburse yourself with an HSA. And also there are some requirements on there. So this cannot be a private club owned and operated by its members, and does not offer golf, hunting, sailing, or riding facilities. the health or fitness component of which is not incidental to its overall function and purpose, and which is fully compliant with the state of jurisdiction and federal anti-discrimination laws. Okay. So treatment of personal trainers. So personal trainer would be a qualified sports and fitness expenses. However, it does not include any amount paid for videos, books, or similar materials, remote or virtual instruction in a physical exercise or physical activity, unless such instruction is live, or one-on-one personal training. Okay. Let me scroll down here. So the membership needs to be at least for 1 day. Okay, there is going to be a cost of living adjustment for that. Okay, that's good. Okay, so next one for the HSA. Right now, the HSA, if you have a family plan, you and your spouse, let's say you turn 55 and your spouse is also 55 and older, only when do the catch-up contribution of $1,000, which is stupid, right? Because in order to get away from that is if spouse one has one single HSA account and your other spouse has a HSA account, then he and she can do the $1,000 catch-up contribution. They're changing this with this is that now they can do $1,000 per spouse if you're both over the age of 55. Okay, so that is really good news, and I'm glad they made it onto the bill. Treatment of additional contribution amounts. Okay, I'm going to talk about the contribution limits here. Well, before that, this is another thing that made it, which is the FSA and HRA terminations or conversions to fund HSAs. FSA, in my opinion, is probably, it's not great. It's just not great. Okay. You can deduct your taxes. You can, it's a tax deduction tool, but it doesn't have that carryover. You cannot carry that over every year. So there's a carryover limit to that, right? So let's say, you don't want to use the FSA anymore because you have healthcare. Let's say you have the healthcare FSA and then you switch it over to the high deductible health plan that comes with the HSA. And let's say you have like $1,000 left in your FSA. Now you can close that account and move it over to the HSA, like a direct rollover from your employer's FSA over to the HSA. So that's really cool. And I'm glad they're doing that. However, this is a big however, a rollover of any kind is going to count towards the contribution limit for that year, which I'm going to talk about the new contribution limits in a little bit. But the contribution limit is going to count. Like if you roll over $1,000 and the let's say your limit is $4,300, now you can only contribute up to $3,300. Okay, I hope that makes sense, right? And the next one is talked about that conversions. They're going to start putting qualified HSA distributions on your W-2. And it's just the special rule. Okay. Yep. So if you decide to start an HSA under the HDHP, now you can begin up to 60 days prior to the coverage date. So let's say you start on January 1st and for your HDHP, now you can go backtrack to November of that previous year, and you have that 60-day period to reimburse yourself with the HSA expense for the qualified medical expenses from your HSA. So that was one of the proposals that was also on there that made it to the bill. Okay. Now, if you, let's say you and your spouse, if you have an HSA and your wife or husband, whoever, works at another job and has an FSA, healthcare FSA, before all of this, your spouse cannot or could not contribute anything into the HSA because you cannot be enrolled into, you have a non-HDHP plan and your spouse does, right? But now they're striking that if one spouse has a FSA, you can still contribute to the HSA. Okay, I hope that makes sense. That is just one of the clauses, is that if one spouse had a healthcare flexible spending arrangement, the spouse individual for any plan year of such arrangement. Okay, I'm not going to read it verbatim. The spouse could not contribute into the family plan because the other spouse had the FSA. I hope that also makes sense. I'm sure that could be a little bit complicated here. All right. All right. This is a huge one. Increase in health savings contribution limitation for certain individuals. So I'm happy with this, and I'm also not happy with it. And I'm going to show you why. All right. So in 2026, the contribution limit came out about 10 days ago from the IRS. The 2026 HSA limit is going to be $4,400 for individuals and $8,750 for family plans. All right. So if you need to write that down, you can plan for it for next year. And there's going to be an extra limits of 4,300 and 8,550 in addition to these limits. So you could contribute up to 8,700 for individuals or 17,300 for the family plan. But there's a caveat for it, and I'm going to show you what it is. Okay. So I want you to remember this. This is the standard limit for anyone, regardless of your income. There's no income phase out range for it. This is the extra limits on top of the standard limit with an income phase out range. Okay. So the income phase out range for single individuals begins at $75,000 for modified adjusted gross income. And it phases out completely at $100,000. So if you make over $100,000 a year, your HSA extra limits right here you're not going to be able to contribute that extra limit. And if you are married and filing taxes jointly, then the limit is going to be $150,000 and it phases out completely at $200,000. So if you make $175,000, then you can just, divide this by half, and you can still contribute half of it. You have to be careful with this because your HSA might not know, or they're probably going to ask you to put it in their database now that this is coming out. You need to know your modified adjusted gross income. If you're over $100,000, just stick to the standard limit. If you're making less than $100,000, then go for the extra limits if you want to. And if you're married, filing taxes jointly, it's $200,000, that's the completely phase out range. All right. If you make more than $200,000 a year, then don't worry about the extra limits. Just do the standard limit. Okay. So yes, they are still pre-tax. So what that means is that you can deduct taxes from this because these are pre-tax contributions. All right. So if you are making less than $150,000 a year as a married couple, and you want to work on your HSA, that's $17,300 for the family plan. That's incredible. And it grows tax-free. And if you contribute to your HSA directly from your job's paycheck, you don't need to pay the Social Security and Medicare. So that would be the 6.45% plus the 1.45% that you can write off, that you don't have to contribute to. So that's pretty neat, right? So it could save you a lot of money on taxes if you do this right. And if you're married filing jointly, $150,000 would put you at about 22% marginal tax rate. So 22% multiplied by 17,300, that's how much taxes you could save, right? And $8,700, if you're making $75,000 a year, that's gonna be, extra 22. Yeah, that would be a 22% marginal tax rate as well. California and New Jersey do not allow you to deduct your state income tax. So that's really the difference. All other states do. Just California and New Jersey, they don't recognize HSA as a state tax deduction for the state only. All right. No, what I'm saying is if you make less than $75,000 a year, then you can contribute to the extra limit. That's what the bill says. So this is the extra limit and this is the standard limit. Standard limit for everyone. And if you make less than $75,000, then you can contribute the full $8,700 for individuals. But the phase out begins at $75,000 and then it completely phases out at $100,000. Okay, and for family, that's also what I just said. But anyway, but yeah, but it's the opposite to Jennifer. All right. Anyway, cool. So that is exciting. You could boost your HSA. HSA is something that you do want to boost, and that's something that a lot of people don't think about is the healthcare expenses when they go into their retirement. HSA can pay for your Medicare expenses, so you don't have to take money out of the HSA. No, I'm sorry, out of the Social Security to pay for Medicare premiums, right? If you pay, let's say, $200 a month on Medicare, you can use the HSA to pay for that instead of taking out of the Social Security. And that's why if you're still young and you're healthy right now, take a look at the high deductible health plan and see if your employer offers it. Just take a look. All right. And I have like full tutorial on the HSA that you can take a look on my channel when you get a chance. All right. Okay, so this is the expanded limits only. Okay, so this only applies to employee contributions. Okay, so I do want to clarify this too. So right now, I'm going to use, I don't know, let's say this year as an example, $4,300. That is as a single individual, right? That's the employee limit. But if your employer contributes $1,000, okay, then you can only contribute up to $3,300. It does subtract. Unlike your 401k is above the employee contribution limit because there's another limit to that, which I'll talk about some other day. But when it comes to HSA, if your employee limit is $4,300 for individual, and your employer is gracious enough to put $1,000 into your HSA, make sure that you only put $3,300 as the total. All right. It's this. So this. But the difference is this is employee employer limit. I should change that to employee employer total limit. Okay. The extended one. Let me scroll up here. The extra limit of another $4,300. That $4,300 is for employees only. Okay, so your employer, if they decide to put any money in it, that only goes into the original employer limit. And let me change that to 4,400 because that's for 2026. All right, I'm going to give a better example here. 4,400 is the 2026 HSA limit. So when your employer puts money in there, it goes into this bucket, and now you have $3,400 left. And if you make less than $75,000 a year, then you can contribute an additional $4,300 into your HSA. That makes sense so far? So clear as mud. That's what I used to say. All right, cool. Anyway, let me move on. Okay. Okay. So, I didn't highlight that. I apologize. This is taking effect in 2027. Holy cow. Okay. That it was taking effect in 2026. It's actually starting in 2027. So the contribution limit, this is for 2026. We're going to get the 2027 limits in around April or May of 2026. Okay. Okay. And I am going to skip the next section, subtitle B. So this is more, if you want to read this, this is starting on page 136. Make rural America and Main Street grow again. So I'm going to skip to page 216 here. That applies to most people here. Okay. All right. Subtitle C, Make America Win Again. Okay. This is going to be the termination of previously owned clean vehicle credit. Okay. And the next one is going to be the termination of clean vehicle credit. Furthermore, about the just kind of talking about the what year the vehicle is going to be and whatnot. So let me just summarize this real quick. So the company that sells this vehicle has to only sell less than 200,000 vehicles per year. I don't know if Tesla qualifies it. I don't know if other companies qualify it. I'm not sure. That's something that you can look into. But just kind of summarize everything. the energy credit for the new vehicle purchase, that's $7,500, is going to be done after December 31st, 2025. So if you're looking to buy like I don't know, a Tesla or some kind of other energy vehicle, that $7,500 tax credit is going to be gone starting on January 1st, 2026. Okay. So let me go ahead and get to that real quick. All right. Termination of alternative fuel vehicle refueling property credit. That's also gone. Termination of energy efficient home improvement credit. That's huge too. So if you just bought a house, I just bought a house, and we did a lot of upgrades to save money on utilities. And, we get credits for those, right? It's not a full credit, but we get partial credits. Those are all going to be gone starting in 2026. So this is going to end on December 31st, 2025. And you can go to page 220 and read all the stuff. Like we have a tankless water heater, which is amazing because it's timed on when we use the hot water for showers and, dishwasher, laundry, and stuff like that. It's a smart water panel a smart tankless water that we got. And, that is going to be, we're going to get some tax credit for it. But after 2026, that's all going to be gone. So, yeah, take a look. All right. Let's see. Termination of residential clean energy credit. Pretty much all the energy efficient ones are going to be terminated. So if that's going to be the summary for you, that's what those are. All right. So let me go to page 233 here. Clean energy electricity investment credit. Okay, that's the same thing. Let me go to page 240. Okay, clean fuel production credit is also gone. Restrictions on carbon dioxide sequestration credit is also gone. Okay, phase out restrictions for zero. Yeah, this is also another nuclear power production credit is also gone. Let's see, did I miss anything? Hydrogen, yep, phase out restrictions. Let me see. Okay, let me see if I missed anything. Don't think I did. Appreciate all of you guys live streaming. Let me go and give out some membership gifting here for you guys. See if I can give it out again. Nope. Did I exceed the limit? Sure did. Okay. Cool. Yeah, just a way for me to say thanks and enjoy that membership and get some of the videos in advance before it becomes public. So appreciate you guys being here. All right, let me take a look. Yeah, we talked about this, the sports franchise. So, they talked about just getting rid of all the tax breaks for the major sports teams. That's all going to be gone to pretty much offset all the tax cuts that we're talking about. Okay, SALT deduction. Here we go. It's all the way to page 255 for the SALT deduction. So this is what is being proposed. So if you're just tuning in, this was a huge fight within the Republican Party. Democrats didn't care, right? So I'm not saying they didn't care, but they did not care about their infighting they had going on. Most Republicans wanted to get rid of the SALT deduction, but they needed the California and New York, which have very high state income tax rates, right? And they wanted to keep those on. And then instead of getting rid of them, they are increasing the SALT deduction limit to $15,000 for individuals and $30,000 for married couples. And rest assured, they're going to have an argument during the committee meeting for sure. And it is going to be reduced by 20% of the excess of the taxpayer's modified adjusted gross income over $200,000 in the case of a married individual filing a separate return, and $400,000 in the case of any other taxpayer. All right, so that's all on there. Cool. So they almost got rid of it. Again, most Republicans did not want to keep that on the bill. All right, next. This is interesting and really random too. Uh, if you have, if you like firearms, I guess the silencers are, they're going to do a reduction of tax on firearms silencers. Okay. That's on page 313 if you want to read about that. Let me see. I think that's about it. Let me see. So yeah, okay. So all the tax credits, premium tax credits that you apply for, and as well as the tax deductions, they are asking for social security numbers. Okay. So if I go all the way to the back of the page, it says the debt, increasing debt limit. Yeah. So it's going to be $4 trillion. So yeah, almost 400 pages. Um, if you, oh man, it was a lot to read, obviously. So SALT, state and local taxes. If you guys really enjoy this type of content, just let me know in the live chat. And, I'm going to stay up to date on this and keep an eye on the bill. What I'm going to take a look at is what time their meeting is going to be. And I'm going to make sure to share the link with you guys. Let me see here. Full committee meeting. And there we go. Yeah. Okay. So let me take a look. I know some of you guys are asking about the federal benefits. Don't think all right, hold on. Let me see. There's a link to that you guys can take a look on your own. 1 second. Let me see. Let me take a look. House Oversight Committee. Nope, no changes. Yeah, no changes. That the committee already approved the vote, so they already voted on that bill for the federal employees. So that's just sent to the House Budget Committee for the final bill. So what you want to wait for right now? Let me share the screen here real quick. So this right here, I'm gonna put this in the live chat so you guys can track this on your own. So the House Budget Committee cannot. They don't have that final bill until they finish this. The Ways and Means Committee, right? That's what I just went over. You can go to that link and just take a look at it on your own. Okay. So they didn't get rid of the federal issue. Like I said, go take a look at it on the website. Okay. That's on there. I just posted that link, right? And then take a look at the energy and commerce. That is also, they got the markup, and that's the other issue is about Medicaid. All right. So these are the things that they are waiting on for the committee to vote on. So once they vote on these, right, take a look at the Oversight Committee. It says committee approved 22 to 21. So it's already sent up to the final draft. So that's all on there. If they're going to change anything, that's going to be at the final bill. All right. So if you're going to keep track of it, please visit this website. I don't want you to wait for me to make any announcements. I don't work for Congress or anybody in the public sector. You have to keep track of it on your own and say, all right, when is the final bill going to be done? Today, they're going over the Medicaid, which is a very controversial topic, right? And they're going over the Ways and Means Committee, which is the taxes that we just went over. Once they vote on these, then they're going to draft the final bill. And they look at it, they argue over it, right? The entire House argues over it. And once they argue over it, they vote on it. They vote on the bill, and they send it to the Senate. The Senate argues over it, they vote on it, and then the president signs it. So what you want to pay attention to is when that final bill comes out. Okay. When the final bill comes out, that's when you need to really read through what made it to the bill. And they're going to have it by section, the Ways and Means Committee, and then there's going to be the Oversight Committee, the Judiciary Committee. That's got a lot of the the law stuff on there, but that's what you want to take a look at. On the top here, you're going to see the resources. You see, these are old right now. It's from April 10th and February 25th. My guess is that around probably right after the Memorial Day weekend, we're going to get the latest bill here. Okay. So if you scroll down here and look at the Senate one, this is a CRFB tracker, reconciliation tracker. As soon as the House passes it and they get those votes, then it's going to be sent to the Senate. And you're going to see right here status, and it's going to have the latest date and the latest bill that's adopted or amended by the Senate. Once they vote on that, or they could send it back to the House for more votes if they don't agree on it, whatever that may be. My point is, please, please, please do not rely on me to give you the updates. I want you to take a look at these updates. Anything about the federal employee pensions, those things need to come from your union. Those things need to come from your OPM. Those guys are the ones who should be giving you the news. If they're not giving you any news, that means that they don't know either. Like I said, these are all very, very fluid, right? We don't know if all of these tax bills are going to be passed. We don't know if the Social Security tax cuts are going to end up happening. I doubt that Trump has even read that bill yet. Trump could be like, whoa, hold on. I promised the American people that I'm going to cut all Social Security taxes, and your bill doesn't say that. So if that makes it to my desk, I'm going to veto it. If he says that, then the House needs to do this all over again, and they're going to argue, and they're going to vote on it, and then they're going to push it back. There could be a delay. There could be a much more delay than July 3rd. That's what I saw last time is they're hoping to have the president sign in July because the debt ceiling is going to expire around July. And, that could be a problem, right? Until they pass this resolution. But anyway, please keep track of this. I care about every single one of you. I really do. But that's why I post all those links, and it's also going to be in the description below because I want you to keep track of this. Your personal finance is very personal. I don't know your situation. You may be someone who's looking to retire soon. You may be someone who's getting ready to collect Social Security. You may be someone who likes to work overtime and, or collect tips. Who knows, right? But I want you to pay attention to this on your own. And this is a responsibility of every American people to make sure that we pay attention to this and contact your congressman, congresswoman, or senators and let them know about, how you feel about it. And I did a video the other day, which is going to be published on Friday, about what I wrote to Congress way back in February about my retirement proposals. Some of them made it. I'm really happy that some of them made it, especially about the HSA. A lot of the rules about the HSA from 2004 are so outdated, right? So I put them in the proposals, but some of them didn't make it, which I'm very disappointed in. As I know, I'm not going to get all the wishes, right? But those are the things that we can do as American people, is to contact our representatives and let them know that you're not happy about something, or, you want to see some changes. You're the voice, right? And if they still can't do it, you did your job. And that's just what it is, right? But anyway, I'm going to try to provide as much updates. I don't want to turn this channel into news, which is not, right? These are a lot of the updates that's happening right now. And there's a lot of updates going on in 2025. It's crazy. My channel is about financial independence and retire early. I started with $110,000 in debt, and now I have over 7 figures in net worth. How I got there, that journey, the fire journey, is what I like to share on my channel. Taxes matter. Taxes so matter when it comes to retirement planning. So if you're not paying attention to what the HSAs are going to do for you, the HRAs, Social Security, all those things, how they're going to affect your retirement planning, you need to start paying attention. Okay. I want you to pay attention, not to the point where it stresses you out, but so that you have a better planning. So in 20 years, 30 years, you're not going to be blindsided and say, whoa, hold on. What do you mean that 529 can be rolled over to my kids' Roth IRA once they hit age whatever, right? Those are the things that you want to know. Go check out my channel. I have a bunch of resources, a lot of them, how to do it, what to do, all that. You can schedule a consultation with me at firesightshare.com/consultation for 60 minutes if you want to talk about your personal finances, all that stuff. All right. But with that said, I really appreciate you guys being here. I will be back in a couple of days, not live stream, but just go more in depth about the HSA and other things that are coming out. Again, these are the proposals. They're not final. Keep track of all the statuses that's going on. Please keep track of them. Okay. But until next time.